Hang on just a second, guys. All right, let's get right on into it. So for everybody who's going to be watching the replay, welcome, tune in. Let me pause this and let me pull up my PDF. All right. So the first thing that we're going to go over, and we're going to go over this every single session, as you guys know, every Monday night. It's supposed to be 7:30 p.m. Central Standard Time. I apologize for the delay, apologize for the wait, but we're going to jump right on into it. So the first thing that we always talk about is the reflexivity framework. Reflexivity is a concept that was created by George Soros. George Soros, again, is the only Forex trader in the world who's made over $1 billion in one day trading Forex. So again, if you want to learn basketball, you learn from the best. You'll be studying Michael Jordan. So us studying George Soros, we figured out that he has a concept called reflexivity. Okay, what reflexivity is, it generally means cause and effect. Now, the root variables for this overall thesis are the X and Y axis. So the X variable is considered the unknown, and the Y variable is considered the known. Now, you don't have to think too much on the root variables. This is just giving you the idea of how trading and the mechanics behind it was developed. And that is based off of the X and Y axis. Okay, so the human phenomenon and natural phenomenon are two phenomenons that George Soros kind of realized. And the realization of it all is this is what's causing the markets to move in its up and down manner. The human phenomenon, or the HP, is to react to what you see in the markets. So generally what that is, if the markets is going up, you'll react by buying. An example of that is, let's say, a traffic light. You are driving your car and your traffic light turns yellow. You automatically begin to slow down, which is a basic reaction to what you see, because you know the rules behind that already. You know yellow means slow down, red means stop, green means go. Forex and trading works the same way. There's rules, okay? Once you learn the rules, your reactions become different. Your reactions become a lot more in sync with the markets. Now, the natural phenomenon, or the NP, is when the direction becomes obvious in markets. So what that means is, let's say the same traffic light that was once yellow is now red. So at this point, you've made a complete stop because it's obvious that the traffic flow is stopped completely. All right, so it's as simple as that. Now, the reason why that's important is because you have to understand that this is what causes the currency movement. So the currency market movement is based off of fluctuation of price. Okay, and that price is based off of expectations of other traders. The direction that the traders see the market currently going in is what they expect to continue to happen, not realizing that the markets can become self-fulfilling. And there is no equilibrium within the markets because there's no perfect competition. So before I continue, let's talk about the self-fulfilling aspect of it. What that means is, let's say Sunday night, you do a setup and all your signs and all your confirmations point to that setup being a good buy. And you buy on Monday morning, let's say, and by Monday night, the market is done what it's going to do. And let's say it went up, okay, or it went down, whatever you want to think about, however you want to think about it, I want to say. The moment that you realize that you're in profit or not in profit, you're going to begin to emotionally react. That emotional reaction is going to create something called a self-fulfilling outlook on the markets. And what that means is that you're going to relate everything you see to why this market is going to go up, continue to go up, or why this market is going to continue to go down. Not realizing that that emotional reaction is what's going to jeopardize your profit or your loss overall. Because let's say that market was in mid reversal. Yes, it went up at first, but then it reverses and goes, instead of 20 pips up, it went 20 pips up. Let's say now it goes 60 pips down. And the only reason why you remained in that trade is because it became self-fulfilling. Now everything that you see, you related it to becoming more of a buy, rather than seeing the markets at an exhausting point and seeing the markets about to return and reverse and so on and so forth. So what I mean by this is that every trader, no matter what, how long you've been trading, what you trade, the markets can become self-fulfilling once you come up with that bias that's not based off of facts. Now, the bias, and the thing about it is that we created our bias in the beginning of our setup. That's step one of the order of operation. is to establish a bias. How we do that is by checking the indexes, okay? Us checking those indexes allows us to use facts or the economic data that's represented within a positive and a negative result. So that economic data is our bias, okay? The reason why we need that bias to be based off of economics, okay, and not our own personal outlook is because everything else, if I don't use economics and I use just my own personal reaction and based off of what I see, it's going to become self-fulfilling, okay? I'm going to relate everything to the reason why that market is going to go up or why that market is going to go down. And that's not the way that we want to trade. So we always check our indexes to create our bias. Now, the reason being is the currency pairs are set up as so. You have USD versus the Japanese yen, okay? GBP versus the Japanese yen. Now, what that versus could be either times or whatever, but the question here is which one is strong and which one is weak. Now, if they were both strong, let's say, this is where you see consolidation. If the US dollar was strong and the Japanese yen is weak, this is when you'll see an uptrend. If the US dollar was weak and the Japanese yen was strong, this is when you'll see a downtrend. Now, there's no other way for us to know if that currency X is stronger than currency Y if we don't have economics, if we don't use economics, okay? Because this one line can't show us strength or weakness against each other or against these two counterpart pairs here. It doesn't naturally show us that. The only thing that these currency pairs and the direction of the charts show us is which direction the market is going in as a whole, not individually. So we break down indexes, or we break down the individual, or we break down a currency pair, sorry, to individual currencies. So that way we can understand which one is stronger or weaker than the other. So let me pick back up here. Realizing that the markets are self-fulfilling and that there is no equilibrium within the market. So what that means is there's no perfect competition because there's no actual buyers and sellers. As you know, the words buy and sell mean up and down in the currency markets, therefore shows us direction and not supply and demand. The only thing that shows us supply and demand is economics, okay? Since not showing us supply and demand, then we know that that the markets is moving based off of expectations. And those expectations are different. Everyone's expectations are different, which creates that fluctuation of price. If price didn't fluctuate, as I always say, we can have one straight line that went both up and down, okay? But the thing about it all is this straight line has an equilibrium. We can find the 50-50 area between top and bottom. But fluctuation, you're not allowed to see that. So that goes into step 2 of the order of operation, the trap. The trap is our support and resistance. What we're doing with that support and resistance is we're trapping the market in a range between the high and the low. Once I have that market now trapped in the range between the high and low, I can find the equilibrium. And that goes into step 3, the triggers. How we find the equilibrium is we use our 38.2 zone. And that is the equilibrium, not the 50, not the 618, not the 786. It's the 38.2 zone. So this would be the equilibrium between the high and low. What is showing us at this 38.2 zone is a pattern as well. Uptrends make this structure, up, down, up, down, up, down, up. Downtrends make this structure, down, up, down, up, down, up, down. So we know the concept of called WVVM, okay? WVVM is this market structure that you see. WVVM is representing the uptrend, okay? MVVW is the market structure that's representing a downtrend. So that's basic market structure. That's how we're able to know which direction the market is basically going based off of a general reaction and not emotional reaction. So let's continue to go through this thesis here, though. So economics is based off of what? Supply and demand. Now, currency is based off of price, time, and events. So you have three variables involved when you trade Forex. You're basing your trades or your analysis off of price, time, events. So the way that this works is you both have a secondary and a dominant, just like you do when you look at your currency pair. The dominant is the first pair listed, the secondary is the second pair listed. The dominant leads the direction, the secondary follows generally. So what that means is natural phenomenon or time and the human phenomenon or price. This shows us two different things. One is an unknown and one is a known variable. Price is an unknown variable. Time is a known variable. I'm gonna break down each individual aspect of them, and then we'll continue and go into the charts, and I'll talk about broker accumulation. So time is the most important thing in the currency markets, reason being it is a known dominant variable. The main reason time is more important than price is because time enables price to continue in its natural direction. Time also is the main factor in micro and macroeconomic events. Economics lead price, which in theory, if it was not the case, price can continue in an irreversible direction because as a trader, your bias would never really change without an element causing or allowing you to react, or which we call as the natural phenomenon. The events or the natural phenomenon, okay, it's obvious, it's a known. Micro and macroeconomic events results all are known variables. They give us either a positive or a negative result that equals variable difference. They'll show us individual currency strength or weakness. Okay, so every event that comes out both micro and macro economically are all based off of and measured using positive and negative results. So our job is not to predict the event. Our job is to react to the event's result, because that thing that you have to realize, or the saying that you have to realize, is technicals must support fundamentals. It's not the other way around. So fundamentals lead price, or economics lead price. That's why we check our index first. Okay. Now, first thing, or the natural phenomenon in time, did price change since the last events were released? When is the next events? These are all known variables because they can be answered. I can look at an event on my global economic calendar and see if it was a positive or negative event. I can see the time and the result of that event at that specific period of time, and I know when the next ones are coming out. So therefore, it's all obvious and known, a known variable. Now, price. This is where most people spend the most of their time, and this would be considered technical analysis. Most of the people spend more time worried about technical analysis rather than the economics and the fundamental analysis that's really leading the price. So price is the only reason for price is this is how movement is measured. Okay. This is considered an unknown variable because there's no way to test the accuracy of price at a specific time. Okay. I'm going to say that one more time. We can't test the accuracy of price at any particular time. There's no way to do that without using economics, okay, without using fundamentals. Though that economic event is going to allow us to know, let's say we have an event, this is an example, we have an event at 12 o'clock p.m. The market's been going down the whole entire day. 12 o'clock p.m. comes out, the market starts shooting up. What caused that market to go up? That event at 12 o'clock p.m. The market started to shoot up because it was 12 o'clock p.m. The event came out, and the event must have been a positive event, allowing that currency to gain strength over the other currency, which then led price. And our job is to react to that, okay? Not to predict where price is going. Only job is to react. So price, time, and events. This equals to currency pair direction. So all three of these must be equal. Okay, not equal. All three of these variables must work together to establish a true trend. Pardon me. The human phenomenon or price. So we're gonna talk about volume and the human phenomenon real quick, and then I'm gonna jump into broker accumulation because it's gonna tie it all together. So price. The reason for price and the reason for your candlesticks is to show us where price is and where price has went. So for example, the way we realize that and the way we see that, for example, we have a candlestick that looks like this, okay? You have a wick that looks like that, okay? And let's say you have the price marker. So what this is showing you this is the line on your chart that shows you where price is currently at. So let's say the open price marker is here. So this is where price currently is at, okay? Current price. That candlestick showed us where price went, right? That was the highest point, and it's showing us where price is, okay? What useful information can we pull from that? Well, a lot, okay? And that's going to tie into our brokers and what the brokers do. So let me continue here. So we can measure and trap current price in a range. That's basically what we do with our highs and lows, okay? Now, accumulation of orders can be seen in volume and candlesticks. What accumulation of orders is this wick, this exhaustion, okay? It's called a fractal, a wick, an exhaustion, accumulation zone. There's a million different things that you call that wick. The importance of this wick is it showed us where price went, okay? The body in the open mark or the current candlestick marker is showing us where price is, okay? This body is also showing us where price went. Below here is also showing us where price went, okay? So when we look at the brokers, we have to realize what their job is. Their job is to trade against you and to make money against you. It's not to pair you up with another person around the world that you're trading against, never. If you buy, the brokers are selling, period. Now, the one thing about price is we can't see floating price because of the decentralized market. There's no primary exchange that all transactions run through. So what that means is the volume differs from broker to broker. Why would that be an important thing to know? Floating price, because that tells us the quantity of currency, how much currency is being traded at any specific point in time, okay? Forex volume can be officially quantified because there are too many brokers, both regulated and unregulated brokers, so all cash flow cannot be accounted for. We know the daily cash flow of currency in the Forex markets is $5.3 trillion a day. Open position ratios show us a percentage of how many buyers and sellers we currently have at that specific time for any broker. We can calculate the floating price using candlestick, volume, and order sizes. Okay, so some of the volume calculations, and I'm gonna just tell you about them real quick. We're not gonna go into depth because I want to talk about broker accumulation zones. So volume calculation, one standard lot is worth 100,000 units of currency. One standard lot is also one open position. One standard lot also adds 10 volume points for every one standard. So there's 10 volume points being added every one standard lot that's open. 1K volume is sustainable to create a true trend. 1K volume is equal to 10,000 orders. 1K volume is equal to 10 million units of currency. 1K volume is 1% open position ratio, and 10,000 orders move the market 1 pip. Now, as newer traders, you may wonder what's the importance of that. But you'll start to see that that's going to show you where money is. Okay, you always follow the money, right? So it's going to show you where money is at. Like, is there more buyers or sellers? Is there more people buying the US dollar over the Japanese yen, or is there more people selling the US dollar over the Japanese yen? So volume is going to help you with that. As we go on, you'll see how important it is. But first, let's talk about accumulation zones. Okay, accumulation zones, or A through Z. Accumulation zones are basically something that brokers use to make money. Now, there's a few ways that brokers make money. Stop losses being hit, blown accounts, early exits. One thing I want you to think about, when you lose money, where does it go? It doesn't just float in free space. It goes to the brokers. Your stop loss get hit, brokers just got paid. Blown account, brokers just got paid. Early exits, brokers just got paid, okay? Not on top of the taxes, commissions, swap fees, and also just trading against you. So the three main ways brokers make money is stop loss, blown accounts, early exits. Now, the way that they do this is they know everything about you, but you know nothing about them. So this is how it works. Most brokers, or all brokers, can see where you put your entry. So where price is, where your entry price was at, where your stop loss is at, okay? They know your account balance, okay? And they know what your leverage is. Why is that important to them? Very important. It makes the job a lot easier because guess what? When you put your buy limit or your sell limit or your buy stop or sell stop, your entry, let's just say, into the markets, who are you putting it through? The broker, right? They know exactly the price that you enter in. Not only the price that you entered in, the price that everybody who was using their broker entered in. So what they do is they create pools. You have a C book and an A book. Well, they have an A book and a C book. What that means is if you are over leveraging, you're in the C book. If you're using proper money management, you're in the A book. Now, why is this important? This is a pool of currency. They'll see that they have 50,000 orders, pending orders in a certain area within the market and push price there. Let's say they had 100,000 orders in the C book and they push price there. Okay. Now let me show you how that looks. We have candlesticks. Oh shoot. That look as so. Sorry guys, I'm gonna delete it and draw it back. So you have candlesticks with wicks. Oh my fucking God. Remember, price is showing you where prices, or candlesticks show you where price is and where prices went. So it's showing us all of that. Let me just get our illustration down here. Okay. So this is how the brokers work. The way that this happens is these wicks or exhaustions happen is the brokers go there for a reason. So the brokers must have seen that they had, let's say, 50,000 pending buyers up here. Now, what's a pending order? Buy limit, buy stop, sell limit. Okay. You give your broker too much information. Long story short, don't give it to them. This is why we use call levels. Okay. Instead of buy limits, sell limits, buy stops, sell stops, we rather be alerted when the market gets to that area. That way we can react. So why is this important? Well, if they have 50,000 buyers up here, right? One thing you have to remember is someone has to always be losing money. If the market is going up, the sellers are losing money. If the market is going down, the buyers are losing money. So the brokers see they have 50,000 pending orders up there. What do? They run price up. Okay. How do they run price up? Based off of calculations. That calculation that I just explained to you, every 10,000 orders move in the market 1 pip. If there's 50,000 orders here, they know that that's a 5 pip move. Okay. But what it does is it exhausts price. Once that 5 pips is up, what's going to happen? The wick comes in lower. Once you see this, any wick come in lower than the previous wick, that's who got locked in. So who got locked in here? Buyers. Buyers got locked in here. Okay. Then what you'll see is an indecision candlestick. Okay. We call it indecision, you call it a doji, whatever you want. A wick up at the top and a wick at the bottom. The reason this indecision is now it's trying to choose direction. The way we know direction is chose is 3 consecutive wicks in the natural direction, let's just say. So 3 wicks, 2 more wicks coming below. Now we know price is going down, okay? We also know that the buyers got trapped here, okay? So who's losing money? Buyers. Who's going to be making money? Sellers. The brokers trap both buyers and sellers in the market, but the way that it works is a broker, the trap ranges anywhere from 25 to 50 pips, okay? That can be above or below. Brokers trap buyers and sellers after 25 to a 50 pip move. So let's say now we move 25 pips down, okay? And we see, or the brokers see that they have 20,000 sellers down here. So they push price there. They're going to lock in the sellers. Once the sellers are locked in, you see the indecision candlestick. Now price may range for a minute, consolidate, but the way we know which direction is going is the wicks. So now we got 2 more wicks above it. That's confirmed that the sellers are now locked in and price is going to start to rally up. okay? Now, this cycle is happening over and over again. This is how the brokers are getting you to exit early, blow your account, or your stop loss being hit. Because of this fluctuation of price, this back and forth movement, okay? This back and forth movement is their advantage because they are allowed to manipulate price by using something called a spread. Spread allows them to manipulate price. And what that means is with that spread, let's say price is here, the spread can be here. So when you click buy, instead of you actually entering where price is currently at, you're all the way up here. So now it's going to take you longer to get in profit. And guess what this spread does? It moves. That spread can increase. You may have a 30 spread, which means 3 pips. That 30 spread can go all the way up to however much it wants. Let's say now it's at 150. So yes, price went lower, but the spread went up. Okay, that's a tool that allows brokers to control the psychology aspect of it, allow you to exit early, allows your stop losses to get hit. Your stop losses aren't hit where current price is at. Your stop loss get hit by that spread, that line. When that spread line is coming across your stop loss and price is all the way down here, so you really would have been making money, guess what's going to get hit? Your stop. It's going to hit the stop. Okay, every time. This is how the brokers make money. How do they know where you at? Because you give them all the information. They know where they have pending buyers at. They know the exact price. When you use buy limits, buy stops, sell limits, sell stops, you just got played. You gave them the information they need to manipulate price because they know how many orders is at each area. You're not the only one that's seeing that support area. You're not the only one that's seeing that resistance area. Guess what? There's 50,000 other people up there. And guess who knows that information? The brokers. They have the book. They know that information. So what they do is all calculated, okay? They understand that if they can get price to that area or to a certain level, okay, and they can lock you in, or they can lock those buyers in, they can lock those sellers in. Our job is to read the candlesticks and the wicks on those candlesticks so we're able to clearly see where that trend is at. We're able to clearly see if that's a trap, if that's a reversal, if that's a fake out, if that's a breakout. So this is the candlestick I want you to remember. Indecision. When you see this, just look, see who got trapped. If the wick is up here, buyers are trapped. If the wick was down here, sellers are trapped. See who got trapped. Because now what this indecision candlestick is telling you, it's about to show you the direction. It's choosing. So let's say buyers were trapped. You'll see 3 wicks coming down like that. Now it locked in the buyers. Guess how much the range is going to be? Guess where the next reversal is going to happen at? 25 to 50 pips. From there, boom, reversal. What does it do here? Or here, sorry. What would it do? It would release the volume from that area. Just because it locked in those buyers don't mean that volume is not there no more. Don't mean that money is not there. Let's say there was 100 million units of currency up there. That money doesn't just deplete. The only way that money is depleting is those early exits, stops being hit, and blown accounts. That's the only way that that money is going to get depleted, because guess what? The next time the money comes or the market comes up here, it's going to release all that volume. So guess what you're going to see? Breakout. Okay? Vice versa. Say we had 20 million units of currency here. By the time the market hits that area, guess what it's going to release? That volume. Guess what you're going to see? Breakout. Okay? So we trap the market using accumulation zones. Okay? The trick to finding the accumulation zones, you can add pivots on your chart. Okay, and I'm gonna show you guys exactly how to do it. Then we're gonna end our session there tonight, and we'll pick it up there on Monday as well. So let me, yeah, my shit just froze. Oh man. Sorry. I'm not sure what just happened. My computer just like froze on me. Oh, there we go. All right, so let me show you how to draw your accumulation zones on your chart. I'm gonna just pull up a chart real quick. Euro USD. All right. So what I'm going to do is when I'm going to pull up on this chart, I want you guys to do the same thing whenever you get some time. In order to find these accumulation zones, the easiest way to find it is by using an indicator called pivots. Now, you're not going to use it's not really nothing. It's going to show you price levels. So this is an exhaustion. This wick is an exhaustion of price. Let me get rid of, sorry, guys. We've been working hard all week. All right, so I'm gonna come up to this little plus sign up here. I'm gonna just type in pivots, high and low. As you see, it's giving you little labels. Those are your accumulation zones. You find accumulation zones both on a 15-minute and a 1-hour chart. The 1-hour chart is your major accumulation zones. 15-minute is your minor accumulation zones. So this here is a bearish accumulation zone. This is where the sellers are trapped. I'm gonna put a rectangular box around it. You can do whatever color you want. I just use one like that. That's an accumulation zone. This is a bullish accumulation zone. This is where the buyers are trapped. Your job is to find where the buyers and sellers are trapped. Use the pivot points, high and low, to make it easier until you get familiar with it. So what that shows you is there's volume there. There's volume there. Let's see. Go back here, type in volume. Don't click volume oscillator. You want regular volume. And just hover over that area. Okay. And look at this box over here. Once I hover, it should be tell us how much volume. So there's 19,000 volume points here. Okay. Remember, every 1,000 volume points is equal to 10 million units of currency. So there's 190 million units of currency in this specific area. Here, 6.4. There's 63 or so million. Oh wait, sorry. What is it? Yeah, 63 million units of currency in this area. So what happens is when the market, like as it hits this zone, it's going to release all that volume. It's going to release all those sellers. Vice versa, 15-minute chart. Do the same thing. Just use the pivots for now. You don't got to get fancy. Boom. Boom. Accumulation zone. How much volume we have? We only have 10 million units of currency up here. Okay. Down here, not even 10 million units of currency. We have 5 million units of currency down here. Either way, there's volume there that can be released, and the price will continue in either direction once it breaks those accumulation zones. So tonight, guys, that's where we're going to end our session. Talking about accumulation zones. So what that means is for next week, we'll go on to our next step, so our next trigger, and we'll talk about session breaks and help you with timing. So help you with understanding what each session means, how each session is used, and how you can benefit from each individual session. So